The market can feel like just a wall of noise, right? But if you know where to look, there are some really critical signals hidden in all that chaos. And they can tell us a lot about where we're headed next. So in this brief, we're going to do just that. We're going to cut through all that noise and zero in on the signals that actually matter. All right, let's jump right in.
So this is it. This is the big question everyone's asking, right? Are we looking at more pain ahead, or is this the start of a huge opportunity? Well, to figure that out, we can't just guess. We've got to look at the evidence piece by piece. And we're going to start with the biggest risks out there.
Okay, so first things first, let's do a quick pressure check. Are the major risks we're all worried about actually contained, or are things getting worse? Let's see what the data's telling us.
Look, you can get lost in the headlines all day long, but if you really want to know what's going on with geopolitical risk, just look at the price of crude oil. And right now, oil is actually pretty stable, just trading in a range between 70 and 80 bucks a barrel. As long as it holds below 80, that tells us this big, scary risk is, for now, contained.
And then there's all this chatter about a potential crisis in private credit, right? Well, it looks like that situation is stabilizing too. Take the software sector. It was a huge area of concern, but now it's showing signs that it's bottoming out. What's really interesting, though, is that we're seeing strength pop up in riskier places, like Bitcoin and even high-yield bonds. All of this points to one thing. Those fears of a big, widespread crisis, they seem to be easing up.
Okay, so it seems like the big picture risks are under control. That's great news. But that's really only half the story. The other absolutely critical piece of the puzzle is liquidity. Is there enough cash sloshing around in the system to actually push prices higher? Let's dig in and find out.
All right, just a quick refresher so we're all on the same page. When we say liquidity, all we're really talking about is how easy it is to buy or sell something without the price going crazy. Think of it this way. High liquidity is like a well-oiled machine, everything's smooth and efficient. Low liquidity, that's like trying to run through mud. It's a slog and prices jump all over the place. You need good liquidity for a healthy market, plain and simple.
So, what's the story with liquidity right now? Well, our first indicator is kind of waving a red flag. The MOVE index, that's what tracks volatility in the bond market, is actually rising. And you've got to remember, the bond market is the bedrock of the whole financial system. So when it starts to get shaky, that creates a huge headwind for liquidity pretty much everywhere else.
And then we've got the US dollar. When the dollar gets stronger, it basically acts like a global vacuum cleaner for money. It tightens the money supply for the rest of the world, making it tougher and more expensive to do business. And guess what? The dollar is strengthening right now. So bam, that's our second big headwind for liquidity.
So you put those two together, a jumpy bond market and a rising dollar, and what do you get? You get a liquidity squeeze. Now, this could definitely mean some more choppiness for stocks in the short term, but here's the really important part. This is probably temporary. Trust me, the central banks are watching this like hawks. They are not going to let a full-blown liquidity crisis unfold.
Okay, so knowing all of that, let's get to the real question. Is it time to buy this dip? Let's take a look at the classic signs of a market bottom and see if a genuine opportunity is shaping up.
Well, if you look at something like the CNN Fear and Greed Index, the needle is definitely pointing to fear. And that's a good start, right? The old saying, be greedy when others are fearful and all that. And this is a really critical distinction. We're seeing regular fear. We are not seeing extreme fear just yet.
See, for a real lasting market bottom, you usually need what's called capitulation. That's the moment of just pure, unadulterated panic, where literally everyone gives up and hits the sell button. A great way to measure this is with the VIX, the market's fear gauge, and right now the VIX is hanging out below 30. That tells us there's fear, for sure, but it's not all-out panic. What we'd really want to see for a true bottom is a huge spike up above 40. That's the signal that all the sellers have finally been washed out.
So the key takeaway here is pretty straightforward. A really good buying opportunity looks like it's forming. We're probably close to a bottom. But looking at the sentiment, it seems like we haven't hit that final ultimate low. That last wave of panic selling just isn't there. Yet. Okay, so if we haven't seen that final panic, what should we be watching for? Well, this is where it gets interesting. The answer is to look for the smart money. Because while most people are panicking and selling, the big institutions, they're often quietly doing the exact opposite. They're buying. And I'm going to show you how to spot their footprints.
This right here is such a powerful idea, the false breakdown. It's literally the footprint that big institutions leave behind when they're buying. It's their go-to move to shake people out so they can buy cheaper. Let me show you how it works.
Okay, so let's walk through the 3 steps.
First, the market finds a clear floor, a support level where prices seem to hold up. Step 2, the price suddenly smashes below that support. This is what triggers all the alarms, hits the stop losses, and creates widespread panic. But then, and this is the magic part, step 3, just as quickly the price rips sharply higher and reclaims that old support level. All those people who panic sold are now trapped, and it's a huge signal that the big institutions were on the other side of that trade, just scooping everything up.
And hey, this isn't just some theory from a textbook. We literally just saw a picture-perfect example of this in the S&P 500 futures. You can see it right there. The price broke that key support, caused a bunch of panic, and then boom, it was aggressively bought right back up. That, my friends, is the institutional footprint, clear as day.
So from now on, when you see the market starting to panic, don't just get caught up in the fear. Instead, start looking for those footprints. Look for the false breakdown. Because now you know exactly what the smart money's pattern looks like. The only question left is, will you spot the next one?